Hey traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for July 24th, 2022. We have a huge week coming up this next week. We just got past the ECB. We have the Fed coming up, a lot of important data coming up, and a lot of key levels that are getting close to being tested and possibly broken. So let's get into it and let's talk about what's happening this next week. Well, actually, first, I'm going to actually take a step back and I want to talk about what happened this last week. You know, the euro, following the ECB meeting, even though the ECB raised rates by 0.5%, the euro ended up staying more stationary than anything. Following the ECB press conference, the euro dollar eased off the highs. The 102.80 level became pretty key resistance for the week. And I'm going to take you over to live charts really quick. And by the way, you can go into Forex Analytics. You can get all of the analysis for 30 different instruments. The basic technical analysis is updated throughout the course of the week by me. And a couple other team members. I do the evening analysis or at the end of North American analysis every day, but there are updates that are put out by our team members throughout the course of the week. The weekend analysis is done by some other team members. So if you want the freshest analysis, make sure you come to Forex Analytics and then just click on any one of the tabs: basic technical, harmonic, Elliott wave, candlestick, macro analysis, and you can get the most recent updates of all of these instruments, these 30 instruments that we do cover at Forex Analytics. It's not just currencies, but we tend to be a little bit currency heavy. But let's go into the euro dollar, and I'm going to take you into live charts. I'm not just covering currencies today. I am going to cover what's happening in equities and especially what's happening in precious metals. And we're going to take a look at yields because they do matter right now, especially going into this next week. So let's revisit the euro and why this is pretty important resistance that we're going to be touching this next week. So if you look at the euro dollar, and let's get rid of this Fibonacci extension. You guys might have remembered the 260% extension held the euro last week on the probe below parity. But if you take the most recent leg lower in the euro, from the this is the end of June high down to that low below parity, you'll notice that we're capped by the 50% retracement. You also notice some hourly spike highs up here as well. That's going to be key resistance going into this next week. Now, if we should overcome technically the 102.85 level, the next resistance is going to be the 103.50. Now, the 103.50 level was so big because if you don't recall, that was the previous support from way back here in 2000. Well, I'm sorry, that was the spike low here, right over here in 2016, 2017. You can see that low. That comes in right at 103.30 to 103.50, depending on what feed you're looking at. But just note that that is going to be really important resistance on the way back. So let's go ahead and just put that down so you guys can see it. Now, whether we get above the 103.50 level is going to solely depend on what happens with the Fed this next week. The market is expecting the Fed to raise rates by 0.75% or 75 basis points. That is where the market is looking at moving into this next week. Now we are stalling, and the fact of the matter is, by the end of the week, we're going to be above that level, or we're going to stay below this level. And I think many people that are euro bears do not want to see a move back above 103.50. If we get much above 103.50, you're going to start to see some short covering. And it's not just because of that support, but you'll notice that we have a descending trend line that's really capped us since the majority of this year. So if we start getting above this resistance going into the end of the week, that's gonna be a clear indication that the euro has bottomed, and we're gonna probably be looking for 105, 106 going into the remainder of the summer. I think a lot of bears, euro bears or dollar bulls, are going to be stepping into dollar bullish positions or euro bearish positions as long as we are below 103.50 roughly. Right now, like I was just alluding to, the Fed is expected to raise rates by 75 basis points or 0.75%. Now, will they deliver, or will they even be more aggressive? We've seen, and if you go back to Friday of this last week, you'll notice that the price action in the stock market was very, very bearish. And we're going to talk about that because the economic data that came out at the end of the week, the PMI data, the market PMI data, came in way below expectations and also in contraction levels, below 50. And, when you're looking at data, the stock market data, or that data, was so weak that the stock market didn't like it. There's a point where you get data, it underperforms, and the market's going to applaud that because it feels like the Fed might actually become a little bit more dovish. But when the data is actually weak as it was on Friday, that becomes more alarming. People start thinking that a recession is coming up, or we're in it, or it's going to be here and maybe even more prolonged than previously expected. So when you're talking about data, when data is outsized in one direction or the other, that tends to get a big reaction, and that's what happened on Friday. It's kind of like I remember the story of the three little bears. The porridge too hot, porridge too cold, porridge just right. Well, when it becomes too hot or too cold, that's when the little bears don't really like the porridge, or the stock market doesn't like the data. So anyway. So what we saw is a big reversal in the S&P, and that really held us at the 4,000 level. And if you remember last week's episode of the week ahead, we were actually looking for a rally in the S&P, and that's what we got. But we're stalling ahead of what I think is going to be pretty key resistance, which comes in around 40, 70, 4100. Right around this level is the neckline of the longer term head and shoulder pattern. I still think the risk is that we could rally past that level closer to channel resistance. And if you look at a daily chart, the 200-day moving average comes all the way up at 4,300, 4,350. That is going to be really important resistance on any rally should the S&P continue higher. Now, what would provoke the stock market to move higher like that? Well, that would be going back to the Fed meeting, is if the market starts to feel that the Fed may pivot into more of a dovish stance. We might get a rate hike of 3/4 basis points, or 0.75%, and the Fed may deliver that hike, but sound really dovish in its statement, and maybe even the press conference from Jay Powell. If that is the case, we actually might see a rally in the equity markets, which also would lead us to further, sell off in the dollar. As you can see, the dollar has turned from a pretty key resistance this last week. We hit channel resistance. We are at the 38% retracement of this last whole move higher, and a move back below the 105.75 level would probably elicit some more selling in the dollar index. Now, it's not just the euro story, but the euro is a big component of the dollar index. But I want to take you over to the dollar yen. The dollar yen also fell pretty aggressively from the channel resistance. I've been expecting some yen strength as of late. Unfortunately, personally, I didn't catch the yen on the long side. I was too focused on other dollar pairs. But that doesn't mean that the dollar yen can't continue to bleed lower down towards channel support, what I think is going to be channel support. So what I'm going to do right now is I'm going to take this low that we put in at the end of May to the highs back here in just over the last couple of weeks, and you'll see that the 50% retracement comes in right around 132.90. Let's just call it about 133 yen. That's going to be pretty important support on the way down. So if you are looking at the dollar yen as being a short because it came out of a wedge, that's fine. Just be really cautious as we approach this 133 yen level. Then you're going to have this breakout point that comes in around 131.50. Actually, it's 131.30. And you can see there's a 618 retracement that comes in right around there as well. If I was a bull in the dollar yen, I definitely wouldn't want to see a move back below the 131.50 level. I know that's a pretty big move. I mean, you're already talking a big 900 pip move from the highs, or 800 pip move from the highs. But regardless, the dollar yen does look vulnerable at this point. And one of the reasons why it looks vulnerable is because if you look at yields, the 10-year yield and also the 30-year yield, U.S. yields, they actually are developing a head and shoulder pattern. Now, this is a really important development because if we see yields come down, they may come down for a couple of different reasons. We might see bonds rallying from a risk aversion standpoint, but also yields may be coming down following the Fed, especially if expectations continue to move lower, more dovish for the Fed moving forward. You might see bonds continue to rally, and you might see this head and shoulder pattern develop. This is the 10-year. Okay, you can see there's your shoulder. Here's the head, possible shoulder, and then there's your neckline. But if you take a look at the 30-year, you have a very similar situation where you have a neckline, you have your shoulder, head, shoulder as well. So keep an eye on U.S. Treasuries, because if yields move lower, as they seem like they're testing some pretty key levels of support, that's going to weigh heavily on the yen. The yen is very strongly correlated to bond yields. So if bond yields come down, the dollar tends to weaken, yen tends to strengthen. One of the other things I want to point out is this big reversal that we saw in gold this week. Gold held major support at the 1680, 1675 level. These are lows that we saw back in 2021, and the dip below 1700 managed to hold gold. It was also the 127% extension of this move that we saw in this year, that spike higher into highs, even though it made a lower high. We didn't quite make an all-time high, but that 127% extension did manage to hold. So as long as the 1675 level holds, I think that if you are a precious metal bull, if you like gold, I think these are levels that you do want to be long, because the risk reward favors longs at this point. But if that 1680, 1675 level is broken, that's going to be a pretty bearish event for gold. Now, before I move on, let me mention just a couple of things. Guys, if you want to join one of the most active trading communities out there, make sure you check out Forex Analytics. It's only $1 for 10 days. Make sure you download the mobile app, because it doesn't matter if you're using the premium version or the light version. You still get the mobile app, and you'll be using the premium version while you try out Forex Analytics. That one we allow you to try out for 10 days. Also, if you haven't had a chance to check out the Trader Funding Program, if you want to learn how to trade our money and not your own money, you don't want to put your own money at risk, check out the Trader Funding Program. For an assessment fee, you actually can access our money. You trade in a demo environment. If you can make 10% return without losing more than 5% on a trailing basis in a demo environment, you can actually access our money. You keep 75% of the profits. You take none of the risk. And if you want more information about the Trader Funding Program, go all the way down to the bottom of this page. You can find the link in the description of this video. Watch this 2-minute video. It'll tell you all about the Trader Funding Program. Make sure you all check it out. It's a great opportunity for those of you that maybe don't have access to larger amounts of money, or frankly, you just don't want to risk your own money. You'd rather trade ours and not take any risk. Well, if that's the case, check out the Trader Funding Program. All right, let's get back into the markets, because I do want to talk about. Oh, I forgot to mention this. You know, if you're using the Trader Funding Program, you're not alone. We'll actually give you Forex Analytics for a certain period of time, so you have a community to have trade ideas, support. You want people to talk to with like-minded minds. Hey, you know, you'll get it with the Trader Funding Program. All right, I was talking about precious metals, but I also want to go into silver, because silver, if you guys have not seen it, this is at a weekly 618 retracement. Now, silver is not rallying, and that does concern me when gold bounces and silver is not bouncing. What we'd like to see, if you're a precious metal bull, you tend to want to have the silver to gold ratio moving higher. Whenever you see silver outperforming gold, that tends to be more bullish for precious metals, generally speaking. And so that's one of those things. If you see silver start to really find some buyers down here at the 1830 to 1850 level, then that's going to make me feel a little bit better that a longer term bottom has been forged in the gold market. All right, I want to hit up on just a couple other currencies really quick. Most of you, especially if you listen to the week ahead video, consistently. You know that I've been an Aussie bull. I've been trying to buy dips below the 70-cent level all year, and every time we get lower towards this like 68-cent level, 67-cent level, I'm getting long and I'm buying. I am bullish the Aussie dollar down here. However, the Aussie is facing some pretty key and important data this week. Not only do we have the Fed this week, but we also have Australian CPI, which comes out Tuesday night if you live in North America, but Wednesday morning if you live in the Wednesday morning if you live in Australia or in Asia. Now, I want to show you this triple confluence that is holding up the Aussie and why this is so important. What you're going to notice here is we stopped at the 69.80 level, 69.75, roughly around that price. Now, if you take the high right over here from beginning of June to the lows, you'll notice that that's a 50% retracement. Okay, so it's a 50% pullback in the Aussie from there. What you're also going to notice about what's so important about that is if you take a horizontal trend line and you look at the big breakdown point back here in December, all right, that also coincides with that level. Now you'll also notice this little yellow or orange, whatever color it might be on your screen, moving average. That's a 50 DMA. So we have a triple confluence of the 50% retracement, previous support, 50 DMA, all coming in right at that same level. Now, I'm still bullish the Aussie. I've been actually trading in and out of it, and my cost average personally, I'm just telling you guys personally, and if you're in, by the way, if you're in the Forex analytics community, right, and if you go to the trades room, you can actually see, what positions that we're taking, where our averages are. You can see my Aussie dollar average is right around 68.24. That's as of Friday. So my cost average personally is right around here, but I'm looking to add. I'm looking to get more aggressively long the Aussie dollar. A few things actually have to happen this next week. Obviously, we need to see the dollar move lower following the Fed, but also I want to see a stronger CPI number come out of Australia. So, and we also need to see risk appetite continue to improve. That means the S&P has to get a nice solid move above the 4,000 level. And then I'm going to feel a little bit more confident about being long more aggressively the Aussie dollar. But I am focused really on the Aussie at that 69.80 level. I think above that level, you have to get, more aggressively bullish. And if we continue to hold it, and the dollar pulls back, or excuse me, the dollar bounces, the Aussie might pull back towards the 68-cent level. So keep a really close eye on the Aussie dollar this next week. I think it's going to be very important. Also, one of the other things that I want to point out about this next week is, and you can follow along on Forex Analytics. You can actually look in the calendar here and see the most recent estimates for advanced GDP numbers that are coming out of the U.S. And that's going to be on Thursday of this next week. The reason why that's so important is because the advanced GDP numbers might suggest that the U.S. is in a technical recession as of Thursday. Now, the Fed obviously is the day before on Wednesday, which is really important. And I'm sure the Fed has had the look at the advanced GDP numbers, and they're going to be basing their decision on that. But it could elicit some volatility on Thursday, even following the Fed. So keep that in mind, especially if you take positions following the Fed decision on Wednesday. Thursday may continue to extend those positions, or quite possibly it might even reverse them a little bit. So guys and gals, I want to say thank you so much for spending your time with me. If you like this video and you think it's going to be helpful for you this next week, make sure you give us a thumbs up. It's not just giving myself a thumbs up, it's giving the Forex Analytics team that's working on this video, editing, publishing it, putting it out on social media for all of you to enjoy this free analysis going into this next week. So give us a thumbs up, subscribe to the channel so you don't miss any of our content that we do throughout the course of the week. One of our team members, Dale Pinkert, better known as Forex Stop Hunter. He interviews professionals in the industry, in the financial markets, you know, whether they're economists, they're CNBC talking heads or Bloomberg talking heads, traders, portfolio managers. He interviews somebody usually every day, and we put out that interview for free every single day. So you don't want to miss any of those, because they're really, really nice, extensive interviews that are free for you. So anyway, I hope you guys and gals have a great remainder of your weekend. Thank you once again for spending your time with me, and I'll see you on Monday morning on the free F.A.C.E show. If you don't know how to get to those, just go to where it says webinars on our website. These are the free shows that you can attend every day. Our European show and our North American show. They are free. I'll see you there. Have a great one. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.